3,000 tons of wreckage and cost variance. This is Ken Boyd, the Accounting Accidentally Substack. So 3,000 to 4,000 tons of bridge wreckage laying on the vessel. We've all heard about the Baltimore Bridge collapse. It's created huge supply chain issues for businesses that are waiting on the received items stored on the ship. According to the mayor of Baltimore, the ship weighs as much as the Washington Monument, which I think is just staggering. So what was on the ship? As reported in the Wall Street Journal, the ship carries paper products, machinery, scrap metal, and lumber. Shipments bound largely for India and other parts of Asia that experts say may be tied up for weeks outside of Baltimore in the harbor. I think it may actually take longer than that the more I hear about it. So tied up for weeks at least. It may even be longer. This article explains the potential accounting impact of shipping delays and how business may pivot to meet the challenge. So let's do an example. Let's assume that Maurice owns Eiffel Tower Furniture in Paris, produces furniture for corporations, and Maurice is waiting on a shipment of maplewood to complete an order for 50 cabinets that will be installed at a business client in 2 weeks, and the maplewood's stuck in Baltimore. So the question is, how does Eiffel Tower fill the order? Well, Maurice may be able to find another supplier, but the cost paid for maplewood may be much higher. After all, the supplier has all the negotiating leverage because Maurice really needs the raw material to complete the furniture. And furniture costs include 3 types of cost: direct material, direct labor, and overhead costs. Direct material are costs directly traced to the product. This includes wood and the cost of metal fixtures like handles and stuff. Direct labor is directly traced to the product also. So cutting the wood, assembling the furniture, adding the handles and other fixtures, these are labor costs. And it's not only manual work, but the cost incurred for employees to operate machinery. These are labor costs. And finally, overhead or indirect costs, costs that cannot be directly traced to a product. Instead, these costs are allocated, and they're allocated based on some level of activity, typically machine hours, labor hours, number of units produced, etc. For example, the cost to repair and maintain machinery might be allocated based on the number of machine hours it takes to produce, say, 100 pieces of furniture. So maybe it's $10,000 in cost divided by 2,500 machine hours. You're going to assign $4 in some way as a cost for the product. Knowing why costs are critically important, and this is a key point. It should be at the beginning of every cost accounting class. Every cost must be accounted for and assigned to a product or service you sell. So said another way, businesses spend money to generate sales and profits. That's the point. And the idea that a company just absorbs or eats the cost of a particular service, that's not how business should be done. Instead, all spending must be recouped based on what you sell. So here's an example. Let's say that Eiffel Tower Furniture has scraps of lumber left over from production. Not surprising. Small pieces that remain if the bulk of the lumber was used to create furniture. So an accountant's going to record an expense for the scrap. However, the scrap expense should be allocated to products sold to the customer. It wasn't used for the customer, but it's still a cost. If on average 2% of lumber costs end up as scrap, 2% should be an additional cost assigned to the total cost of each piece of furniture. The price should be increased to account for the additional scrap. So every cost you incur has to be traced to a product or service you sell. Working with cost variances. Okay, back to the supply chain issue. So the maple lumber is stuck in Baltimore, and Eiffel Tower needs to purchase lumber from another supplier. Let's assume that the lumber cost per cabinet increases from $250, which was the budget, to $285 cost per cabinet. Eiffel Tower has a material variance of $285 actual less $250 budget, or $35 per cabinet. That is an unfavorable variance because actual costs are higher than budgeted costs. If Eiffel pays less for materials than budgeted, that's a favorable variance. So spending less is favorable. Spending more than budgeted, it's unfavorable. So the lesson here is you should compare actual and budgeted expenses for all costs, including direct material, direct labor, and overhead costs, and research variances from budgeted costs to determine why the variance occurred. Understanding variances can help you improve your planning and budgeting process. So that's as far as we'll get. My fifth book, 50 Stories That Explain Personal Finances, comes out in the fall of 24. You can email me at ken@stltest.net for more details. And you can also subscribe to more content at accountingaccidentally.com. Thanks for watching.